I want to start with why it is so important for you to be here in terms of the Federal Reserve policy and how it informs what you do at the ECB.
This is where the discussion happens in terms of the Fed's policy, but of course in terms of the global discussion as well. And of course we take our decisions with respect to what is necessary for the euro area, and our target is 2% symmetric. But of course what happens in the global economy and in the U.S. financial markets does affect us as well.
You've talked about how it would be appropriate to have one or two more cuts potentially at the ECB for the remainder of this year. This comes at a time where there's a lot of speculation about a September rate cut. Do you have a sense of whether two or more could even be appropriate?
We'll see. We'll see. But what I would say, of course, we have had so far a relatively mixed bag of data, but it's still within the confines of the baseline scenario that we have. And given the data that we have at the moment, I would be very much open for the discussion of yet another rate cut in September. But we'll see. We still need to see the new forecast. We still need to see August data but for inflation. But overall, I would say, even if inflation over the next few months keeps moving sideways, it is consistent with further rate cuts.
How deep would they have to be? Do you have a sense of what that sort of neutral rate is?
We'll see that. We'll see that. Let's take step by step. Currently, we're still relatively restrictive, and with at least a couple of more rate cuts, we would still remain in the restrictive territory. So let's not jump ahead. Let's take it step by step. And I think, from the current perspective, gradual and kind of step-by-step approach to rate cuts would be the best.
Do you feel like there is still a risk of reacceleration in inflation, or is that risk sort of off the table?
There are some risks over there as well, especially if one takes a look at the services inflation, where we've seen it being relatively stubborn in the range of 4%. But this is consistent with the baseline scenario that we have, and I would say that we're still solidly on the path to 2% during 2025. I would not like to see, however, this to be pushed into 26. Inflationary expectations being anchored and stable have been very much helpful, and I don't think that we should risk by not attaining 2% in a sustainable way quite soon, and then risking us being hit by some other shocks and then pushing inflation away from the target. I don't think that would be appropriate. So 2% gradually, step by step, during 25 would be a nice thing to do.
People in the media, like myself, sometimes will say that the Federal Reserve is central banker to the world. A lot of people at other central banks bristle at that and say, what are you talking about? We're our own central banks. This is not what represents us. At the same time, there is this question of how far the Fed can diverge from the ECB. If the Fed cuts by 100 basis points, like the market is currently pricing in, do you expect the ECB will have to respond with outsized cuts or more than two cuts?
Not at the moment. If you take a look at the current situation, then the ECB was the first to move. And even if the Fed moves by 100 points, as you mentioned, this year, and we, as the markets expect, currently move by 25% twice, so it will be 75%, so 75 basis points. Not a massive difference. We've seen much larger gaps in the past.
Do you think that the inflation problem is bigger right now in Europe than in the U.S.?
I would say that what makes me worried about European economy is the weakness of the economy itself. Growth has been relatively patchy. It has been timid. And monetary policy has done a good job to push inflation down, to create basis for growth, less uncertainty. But there is lack of structural improvements, which has meant that growth overall has been relatively timid. I would look at these differences, and that is, in the current situation, I would say, the major difference between the U.S. and European economies, which is the weakness of the economy.
So at this point, if you're more concerned about weakness, how do you understand rate cuts at this point? Is it, some people are talking about preemptive cuts, that in some ways is trying to get ahead of weakness. Is this instead in response to true weakness that you're seeing?
Of course, we look at the whole set of data. We are not data point dependent, we are data dependent, which also includes the outlook for the economy and inflation. So there is always going to be a forward-looking perspective, and there's always the perspective of the policy implementation gaps and transmission gaps. So there is some element of preemptiveness always. Okay, so I would not draw that a big difference here. We want to see inflation converging in a sustainable way to 2% during 2025, which means taking decisions with a forward outlook.
How much agreement is there right now on the European Central Bank Council?
I think it's quite all right.
You think that people agree that generally there needs to be more rate cuts throughout the rest of this year?
I think we very clearly see that monetary policy is restrictive, and we are very clearly on the path for the rates to go down. And then seeing what happens with the economy, what happens with the data, what is the new forecast that we will look at in September. There's discussion on the pace and the size of the cuts, but by and large, the whole storyline is relatively aligned and clear.
We were just listening to Michael McKeon. He was being interviewed by Carol Massar and Matt Miller, and they asked him about whether there was a political discussion here in any way, shape, or form. And I think about Adam Posen, who's going to be on our show tomorrow, who talks about how the Fed and how central banks in general get ahead of fiscal spending that increases deficits, which is likely going to happen regardless of who wins. How do you as a central banker operate with this idea that you need to increase spending? You see this in Latvia as well with defense spending. At the same time that you're trying to fight inflation that some people say was fueled by some of this spending.
I think this is the issue of the policy mix. Coming back to the issue of the geopolitical shifts and also kind of the issue of military spending, I would say that military spending in case of Europe, by all means, is no spending. It's an investment. It's investment in security and also improving the confidence of households, which we've seen has been relatively weak. And we still see that households are very cautious to spend. That element is still to play out. So I think the defense investment, both for industry, which is overall weak in Europe, and also for the confidence of households is very important. But coming back to the policy mix, I would say monetary policy should do what is necessary to ensure that inflation is quite stable and low. Okay, we have the 2% target. But one should be aware that we cannot, through monetary policy, gain the structural improvements. So structural policies that are extremely important to strengthen growth. And of course also fiscal. And in the European case, it's going to be a very testing time in terms of fiscal story because we need the investments. But at the same time, of course, we have a new fiscal framework. And credibility of the fiscal framework is very important. So it cannot be disregarded either. So it's a tough world. We have to walk the path with our very clear target. But at the same time, there are lots of disturbances from loads of other players.